Hello and welcome to another episode of the SwingTrader Status Update. It's Justin Nielsen here, and I am joined by Mike Webster. As usual, it's July 2nd, 2024. So let's see what we got on the agenda today. I kind of titled this one, Reversals, Hedges, and Chips, oh my, because it's been quite a week. And maybe, Mike, we should start with the downside reversal that we had on Friday. One of those things where you expect some weakness. Why don't you talk a little bit about that?
Yeah, so as you know, obviously, because you did the work with Chuck and I on Market School, and we looked at all of the important variables on the market and really what moved things. And one of the important things that we found was, besides the 21 day, which was kind of at the core of Market School, were things like downside reversals. And that was a classic downside reversal that we had 2 days ago, where you have a spread that's larger than normal. You hit a new high, you close down on the day, which is how they typically happen. Sometimes they close up on the day, but an orthodox one, you close down on the day and you close near the lows and basically the bottom quartile, but as close to the lows as possible makes it look even worse. And we were pretty much dead at the lows on that day. That does not mean the market's topped. What it means is you should expect at least 2 to 3 days of pretty heavy selling. That tends to be what happens. Sometimes it's, a week or two that, where you're just, the market got ahead of itself, kind of have this key reversal, and it needs to come down and shake people out. Well, this time, what happened was it didn't happen. We had the weakness, part of yesterday, but then we had an upside reversal, and we'll look at an example of one of those in the from 2003 in a little bit. But anyways, that alone, the upside reversal yesterday, where you shook out and then closed at your highs, basically the opposite of the downside reversal, that wasn't enough to let us know that we're out of the woods, because sometimes you'll just have one more little blip higher and then you roll. But today's strength just kept building on itself. Let's go to the intraday chart, if you don't mind. And let's look at a 15-minute.
Okay.
And you can see, or the 5 minute is fine, actually, that you have. Let's go back to the 5 minute.
Okay.
And you can see how we just started off weak and we were just building and building throughout the day. So as that was happening, we were removing the hedge that we had put on the downside reversal, because we were expecting more weakness than what we got. And we did that, we put the hedge on with the QID and the SDS, which was, just the inverse, double inverse of SPY and the Qs, just a way of, rather than going short, just hedging with a long. And you know what? We just slowly removed them throughout the day, just because the market was telling us it was stronger than what we expected. So there was no need for that hedge anymore. Well, we'll see what tomorrow brings. It's a half day, famous last words. But given what we had today, you had to kind of remove your hedges, because we could certainly, gap through the last week's highs tomorrow. So,
and I just want to mention that one of the benefits of having that hedge is I think it made us feel a little bit more comfortable holding on to some of these larger positions that we've had. We had kind of moved into some full positions, and putting money into that and into some of the things that were working. And I think it made us a little bit more comfortable that those things weren't breaking down, but we had kind of the hedges protection in case things got a little dicey.
Exactly. And that was the purpose of it, because like you said, we had finally built up these 10% positions, which are full positions. And we didn't want to, we could have gone a couple ways. We could have just sold a bunch of those, put them, down from a 10% down to a 5% or 2.25%. That was certainly an option. So we could have kept our positions, but just had them small and then had to bring them back up today, or essentially hold most of those. We trimmed some things, but hold most of them and put the hedge on. And that's what we're going to be doing going forward as well. And when you put a hedge on, this is what you want to have happen. You would rather get take a loss on your hedge and have it serve its purpose. It's just like, what Bill would always say, Bill O'Neill, the founder of IBD, which is what we have to say because everyone doesn't know who Bill is but he would always say, did you buy fire insurance on your house last year? Are you upset that it didn't burn down?
Right.
And it's the same concept with putting on a hedge. You put on a hedge, it's your insurance policy in case things get really ugly. We would have had that benefit there. And I was frankly, pretty much convinced that we were going to come into our 21-day, which was our green line on there, or even worse, based on our historical precedent of the 03 and 09. It was really in the cards to come down and test partially between the 21-day and your 50-day, which is your red line on there. And that would have been nasty for our full-size positions. So
now, just real quick, before we kind of get to that precedent, I want to go to even more recent precedents with May 23rd, because it wasn't that long ago that we were talking about this downside reversal. And interestingly enough, on Friday, we got up to 18,000, got turned away. But on May 23rd, we got up to 17,000, got turned away. And then I'm just going to play this out a couple of days. We had an inside day. So not that kind of test like we had today, where it was, coming, or I'm sorry. Where we had that test coming down on a little bit of weakness. It was an inside day, but then the very next day, it was right back to new high territory and did cross that 17,000 level. So, I mean, it happened on May 23rd. Should we have expected it to happen this time too?
Well, let's play this one out because this one didn't end the way you would have expected. So this one ended up going lower after that, which was very unusual, frankly, because when you have a downside reversal and then a downside reversal buyback, which is what happened there, where you close above the low or above the high from the downside reversal, that's typically historically an all clear. It is a buy signal in market school when you do that on that one day where we went back above 17,000 closing there. So you think the coast is clear, but as you know, with the market, it doesn't always do what you want, and then you have the shakeout. So that's certainly possible.
That was 3 punishing days in a row, ending with this one on May 31st. That yes, it came back, but I mean, let's all remember what it looked like when it was at the lows of the day, undercutting the 21-day moving average line. You and I were kind of talking about the market school rules, how many sell signals were looking at getting triggered before it finally reversed and actually.
That would have put us down to like a 0 or a 1, right?
It was a 1. The power trend was still keeping the floor intact.
Oh, that's right. So it was an artificial 1.
Yes, but otherwise it would have gone to 0. Yeah.
And that's a great point, Justin, because when you look at these charts, you want to look at it and think about what does it look like on an intraday basis, either at the lows or the high of the day, whether you're looking at an index chart or an individual stock chart, and just think, what would you want to be doing? And, how would you handle that? Now, there's one approach that's not really a swing trading approach, is the more of an orthodox, position trading is you just wait to the end of the week, let things wiggle and wobble throughout the week. And that has its advantages and disadvantages, but that's not really swing trading. Swing trading, you're kind of acting in the moment. We do try to wait until later in the day whenever possible. But when you have things like on that day breaking wide open like that, that's how really ugly days get started. If that kept going lower and would have gone through the 50-day, that would have been a bloodbath, frankly. But you don't know when the bulls are going to step up. You don't know when the bears are going to step up. So you have to act in real time. And of course, it was, Bill's famous quote that he put in the book, there's the quick and the dead. So you have to act quickly in times like that, and then always reverse it back, and you can buy things back. And then, that's what we did there. We sold, which we should have, a bunch of things. And then we had to, buy them back because you want to be fluid. And, the Bruce Lee, be water statement, you've got to be flexible.
And
and
I
that's
just want to, because you mentioned that there's disadvantages and advantages to the orthodox position trading. Wait until the end of the week. Again, you always have to have your line in the sand. But to
yeah.
be clear, let's just spell it out. The advantage is that with shakeouts like that, you're gonna retain your positions. It's
Mhm.
gonna be kind of like no harm, no foul, and you're gonna be able to retain those positions and potentially get bigger gains and hold things for longer. The disadvantage is when these things do, as you said, get uglier, you're going to take bigger drawdowns. There's just no way around it. You can't, you have to kind of find your own balance, and that's kind of a little bit different for everyone. Some people just hate taking those drawdowns so much that they want to avoid that pain, and they're going to be quicker to, get out. And as you said, get back in if need be. Some people are a little bit more patient and kind of taking that long view and are, they can tighten up their stomach, ready to take that punch. But it's not for everybody, so.
Yeah, and you can do something in between. And when we add things or remove things from the list, don't feel like you have to do the same thing that we're doing. Take it as information that this is a style that is short term in nature or shorter term than orthodox. And so we are going to act accordingly. And that means, by definition, we are going to be faster in and faster out of the market. So you are going to get shakeouts, but you are going to get false starts. Those are the negatives. But the upside to that, the balance on there is the drawdowns. You'll still have drawdowns with any style, but they should be smaller than the orthodox ones. If you're just waiting till the end of the week, if you study history, study the market, and you look at both approaches, they both have their advantages and disadvantages. And so the drawdown is really the big thing that you would avoid with this, kind of the quick and the dead type of approach.
Mm-hmm. Let's talk a little bit about this precedents that we've mentioned a few times. I haven't updated this, but you can still get kind of the idea because of what we're really kind of looking at is 2003 and 2009. So is this still kind of holding in your mind, or are we doing things a little funny now?
It's holding, but it is a little bit different. And that's with what we had today was a little bit different than what we had back then, because you notice all these pullbacks after. Just to orient, why don't you walk through what these lines are for people who have never seen it before?
Yeah. So just as a reminder, we're basically looking at the orange line as our follow through day. And this follow through day, of course, is November 1st for the current market. November 1st, 2023. It was back in March 17th of 2003 and March 12th of 2009. And so that's what we're looking at here. And we just kind of played it out. Now, one of the things was, look, both 2003 and 2009 had these really strong uptrends, and there was kind of a first pullback, that was pretty dramatic. 8% here, 7.6% here. It was 8% for us, although ours was a little bit quicker, and made us kind of think that this precedent wasn't holding. And then after that, you did get a little bit more. It wasn't trending as strongly, and that's very normal, right? You get the strong thrust, and then we had a lot more tests of the 50-day moving average line. You'd make some progress, come back to the 50-day moving average line, go to new highs for a little bit, back to the 50-day moving average line. And that was kind of the way we went. So that's kind of one of the things that we're looking at now, is that it would be very normal for us to have some pullbacks to the 50-day moving average line, only because that's what happened in these markets as well.
Exactly. And that was another reason why we put on the hedges. And frankly, given the same information, we would do the same thing again, because these are the precedents that we're using, these two. And the wiggles and wobbles down to their 50-day or breaches of the 21-day, you had a lot of those during this same time frame of where we are with this. So that could still be in the cards. If it follows these two, that is going to happen, and that is going to be rocky, and we're going to have to we're going to have to either put on hedges again when that happens, trim, or do a little bit of both. Why don't we look at that time frame at one of the examples in the O3 to kind of walk through so people can see what it looked like?
Yeah. So I'm going to go ahead and I'm going to bring our market surge back up. But now what I'm going to do is I'm going to change the date here. And this is one of the great features of market surge. I really highly recommend that people use this feature because it's so useful.
Wait, before you
Oh,
change
go
the
ahead.
date, just everyone look at our chart, our current chart, look at the downside reversal 2 days ago, and then what's happened yesterday and today, kind of get that in your mind. And now we'll go back and look at the O3.
Okay.
All right.
Wow. That looks like a downside reversal to me.
Exactly. So that was pretty much what we were modeling this off of after what we thought was going to happen. Now let's go forward just one day.
And just real quick, not quite the same, but it's kind of interesting that there was this pretty big downside reversal here too, where it wasn't on the second day, but on the third day that it came right back to the highs. But yeah, let's go ahead and go to the next day, and
that could still be in the cards. Like that
right.
is certainly a possibility.
So here's the next day.
Yeah. So the next day you have this mild upside reversal, which is like what we had yesterday. And that's why we didn't remove the hedges. Because typically when you have an upside reversal, your expectation is for the market to move higher. But we were looking at this example and saying, you know what? In the past one, you did have this head fake of an upside reversal. Let's play it out another day and see what happens.
One more day. There we go. Yeah. Oh, yeah, that's different.
Yeah. So that was where they dislodged our current market in this one, where our current market, you saw what happened today. We closed at our highs. It's pretty much back near the old downside reversal. And this one, we had exactly what you would think would be normal, which was further weakness. And let's go out, play out, and see how this worked itself out. And lower, which is normal, got support at the 50-day. And we can keep going forward. And that's what we were expecting, right? That's normal. You can see you have a test of your 50-day, nice shakeout, then you go back to new highs. Yeah, let's just go out to, 04. And so you can see you had a lot of those wiggles and wobbles and tests of the 50-day. It ultimately kind of moved into new high ground, then stalled, and then you had your intermediate correction on the right side of this in 04. So this is, and it's kind of similar to the 09. You can, when you get a chance, you can go back and do this, use the change data and market surge and go through the 09 time frame. And it was a lot like this, these kind of violent pullbacks, kind of tricky. We still think that that's probable because that's what our precedent did, or two precedents. But right now we are going to be flexible. Let's go back to, unless you have something else.
Well, yeah, I was going to just say, one of the things you might do, for homework, no one said that there wasn't going to be math in this. I would suggest that you take some of these figures, and I really like how we have them marked on market surge. So just take this 1841.62, divide it by 1966.87, subtract 1. That's your percentage loss for this correction. Do that over and over to kind of get a sense of what these corrections were like. And if you are so inclined, apply that to the current market. Okay, what would a 8% correction be? What would that put us down to here? And that can kind of give you a sense, okay, what the market it could potentially do. So yeah, let's go ahead and go back to forward.
I think those are around 6% or so.
Mm-hmm.
I'm pretty sure that's the ballpark that they're in.
Okay, well, Mike's going to do the math for you.
Well, I don't know. I could be wrong. Don't trust me with a calculator.
Okay, so that kind of gives us a sense of where we're at in the market.
Yeah.
Let's maybe talk a little bit about where we're positioned. And certainly one of the areas that we've taken a larger position in is software. Not only with software names, but also with IGV, the software ETF. And what's kind of your thinking behind this?
Yeah, so I do have a position in IGV,
I do as well. Thank
and a
you for
lot of the
reminding me.
things that we have on SwingTrader, I have positions in. But so with the IGV, my thought process here was for the first part of the year, let's pull up SMH, which I have a position in
I
Soxel,
do as well.
which
Mhm.
is essentially the triple of this. Um, and so this had been leading for the large part of the year. Besides that, the little base that it built. So this was certainly your leading area with NVIDIA, which I have a position, and I think you do too.
A
Um,
small position now,
yeah,
but yeah.
mine is small at this point as well. And so that was the leader, and chips were the leading space. Now let's go toggle back to the IGV. Now that you have this in your mind, and IGV during that entire time frame has been sitting out, has been dogging it, and you can tell with that RS line has just been down. No one wanted software, but that kind of changed after that gap down in there. That was kind of the flush of it, and then it started really kind of wedging up. So we were thinking that you were going to have a pullback in here because as you wedge up, typically what ends up happening is you have a shakeout in there to resolve the wedge, but it didn't. It just went sideways and then moved into new high ground. And this looks like a lot of the software names out there that kind of all trade together. So our thought is that chips could lead again, but the leading group might be software. We always say might be because we don't want to predict, but the evidence is showing that we do a lot of rotations in the market, especially around, half years or quarters. And so I think it would be normal for the market to switch and start gravitating towards IGV type names, software type names. So that's our thesis right now, but we will be either proven right or proven wrong based on what the price action does. And if it rolls over, we'll start backing away from software. If it continues higher, we'll probably be adding some more exposure there, but we're pretty heavy. So we're making a big bet into software right now. And so we'll we'll yank those back if need be.
Mm-hmm. So you talked a little bit about kind of where where we're positioned heavy in software. Let's go ahead and we're going to bring up the pie chart because this is a useful kind of gauge of where we're at. We basically have 5% cash right now. We're in mostly the heaviest is software, and usually if we have ETFs, those have been classified in miscellaneous, but since the two ETFs that we have right now are IGV, that's clearly software, and SMH is clearly chips, I kind of put those in their respective sectors. But software, by far the biggest sector, 35% there. Retail up there as well. Internet, at 12, 12 and a half, a little bit over 12 and a half. And then we've got kind of our smaller positions. Telecom, that's, you can guess that's Apple. But then a few other things where they're smaller, either because they've been on the way, down where we've trimmed, or some things that we just started today to see if we can get some traction and add to those. Any kind of comments on this one?
Yeah. So with this, when you're making a concentrated bet, which we are right now with software, you just need to be cognizant of it. That added risk that you're taking, and is another reason why we had the hedges on to protect us from where we're at right now with the concentration there. They got a little bit bigger today. So it is just one of those things. If you feel uncomfortable being that concentrated in a sector, you don't have to participate in all of it. Just pick and choose the ones you want, or just go with the IGV. And so this gives us the feedback of saying, what, if we're wrong on this, we're going to get hurt. So let's probably not press it too much further. We might add a little bit more in the software, but we're really looking for some other less correlated to software groups. But it's whatever set up. There were a few names that we passed on today that were, in position, but we were making so many changes that we didn't want to overwhelm everyone. And so there was some slower, pokier names. Frankly, I'll just say it, Costco was one that I was looking at putting on, but we, decided not to. One, we wanted to kind of have that cash for something a little bit faster, but I was looking at trying to have some kind of slow and pokier names in there. So we're just making that decision of where do we want to use that little bit of cash that we have before we start venturing back out on margin. So those are the types of names that I was looking at. Also, CDNS was another one that we were looking at. Just to give you an idea of like things that we're looking at everything. Justin and I screen all day long. We're looking at everything. So we're aware. Lots of times we're just making the decision to just pass on certain things that look good. And who knows? We might do them tomorrow. We'll see how they end up looking. So you have the CDNS up there.
Yeah.
So with this one, you had a nice upside reversal yesterday, which would have been the ideal spot to put this on. But we were trading more defensive yesterday because we didn't have today's reaction yet. And so we sat on our hands with this one yesterday and then went further today. So today you could have added on to it. And let's look at Costco just to give you an idea of other things.
I do have a position in CDNS myself.
Okay. I didn't know that. So, yeah. And then here's Costco.
I was fully expecting that I was going to have to sell it.
Okay. So here's Costco, broke out of its cup without a handle. And this is its first real kind of gentle pullback to your 21-day, which is your green line. So from here, your assumption is that you move higher and our stop would have been today's low. So lots of times there are going to be just names out there that are set up, but just because of our exposure level or how many transactions we've already made on the day that we just pass up. But just thought we'd throw that out there.
Mm-hmm. I'm going to go ahead and turn over to Amazon just because we have something that's a little different to discuss on this one. You saw that retail was one of our biggest sector. And Amazon, you can definitely argue with AWS that there's, that whole cloud computing part to Amazon. That's very important. You can't neglect that, but we still do have it in the retail internet, section. So it did get classified as retail, but we went over a full position. Remember, what we're kind of considering a full position right now is 10% of the portfolio. We always kind of take when I'm doing the calculations, I take the value of the portfolio from the day before just to kind of keep everything easy and not like, it's just a little bit easier to take a static number, right? We don't want a changing number. So take the day before the portfolio, 10% of that is a full position. So when you say, oh, we're bringing a quarter position on, or we're doing a half position, you can just kind of do the math. That's a 2.5% position for a quarter, 5% for a half, 7.5% for 3 quarters. But now with Amazon, we were already at full, and Mike is like, hey, I really like what it's doing. It's, earlier he was kind of saying it was a magnet to 200, but then it hit 200 and he's like, I want more. So this is now our first 5/4 position.
Just to make it confusing, we had to do the 5/4. I do have a position in this.
I do as well. Mm-hmm.
So with this one, what I'm looking at is a few things. One, like you said, there's this blend between the retail aspect of it, obviously with the deliveries, but then you've got their music, you've got their video and everything. But the real big, what people trade Amazon for is really the AWS, the web services. So it is diversified between the retail and the internet data, AI. You can classify it in many different themes. And so I think with this base right here that it's just broken out of, the way it handled itself so nicely with the downside reversal that we had in the market, that this one held up better than a lot of the other mega caps, holding above that base, the 191.70, kind of just stopped right up above that. Your RS line is showing that. And so this was something that I think could have just be a launch pad for a bigger move. And it does trade a little bit tighter than some of the other mega caps. It's not as slow and pokey like a Costco, but it's, kind of closer to that than maybe some of your high octane individual
It has
names.
the combination of the let's say the slowness of the Costco, but with the tech aspect too. So
Yeah, that's a good
it's a
way to
nice
put it.
combination.
Yeah. So with this one, we felt comfortable going 1.25. We might even go 1.5 with it. So you might see that a lot more with kind of these bigger, more well-established companies that are big and liquid. You probably won't see that with a thinner name. Not saying that we won't, but probably won't do that. And again, this is only a 12.5% position at this point. And that's small compared to the way Bill used to do things. He would be much more concentrated. So with SwingTrader right now, we've got some 2.5% positions. And of course, we'll do 5, 7.5, and a 10 as a full size. So we're not doing that heavily concentrated thing. So I feel comfortable with the 12.5. We know where we're wrong on this. If it comes back in and takes out the lows from a couple days ago, close below that, we'd have to start backing away. And of course, if it came all the way in to your green line, which is your 21-day, we'd probably be out of the position by then. So that's what we're doing now. So when you see tomorrow, why don't you walk through?
Yeah. So I just want to kind of mention real quick. There was kind of a little back and forth here internally on how we communicate this. So, I put full plus 1/4 because I didn't want to put a 1.25 position because I didn't want people to think it was a 1.25% position, that much of the portfolio. Because as you mentioned, it's and it's actually even hard to say 12.5% because of appreciation. It's actually 13%, right? We've started with 2.5% positions of the portfolio, but now because it's appreciated a little bit, it becomes 13%. That's just the way, it's dynamic, right? The prices change, your weight changes. So we are kind of considering some ways to communicate this. 5/4 is, I think, maybe one way we do this, so that we're not doing 1.25. I was thinking of doing a mixed numeral, 1 and 1/4, but that does kind of look like 11/4 if you're not paying attention to the space right there. So we're kind of toying with how we do this and how we communicate this. So definitely, send us your comments. We would love the feedback on that. And to that end, I want to also mention, we mentioned this before on the show, that we were going to be putting on the current trades, a new column on the left-hand side that will tell you, okay, is this a quarter position, a half position? What is it right now? And so we're happy to say that should be launching tonight. So you might see a broadcast. You might see a broadcast message that SwingTrader is doing some maintenance. That's what it is. Hopefully we launch that tonight, and then tomorrow morning I'm going to have to go in and fill those blanks in. They're going to be null. So don't be surprised if you see what's all these nulls. I'm going to fill those in the morning. As soon as I get the thumbs up and the go ahead. And we're going to go forward, and we'd love to, again, hear your feedback on if that helps folks, makes it a little bit easier to kind of understand where things are. But we're excited, that we've got this thing. It's something that a lot of people have been asking for. Again, right now we're going to be using fractions, 1/4, 2/4, 3/4, full. It'll say full if it's 4/4, just to make that a little bit clearer. And then in the case of Amazon, it's going to say 5/4. So
yeah. So you've got your work cut out for you in the morning. You're going to be a busy body. So I hope that new thing that we're adding helps out, because a large part of this is an educational tool, and I can't emphasize it enough. Don't feel like you have to trade along with every little thing that we do. We're managing this mock portfolio in a very active style, where we're going to be adding to things as they're working. We're going to be subtracting as they're not. And we're very active. And I know that's a little bit too much for a lot of folks. So still feel free using the service and just learning this style, and make it your own. Like you can, let's say we have 10 names on there, maybe only own 5, or you don't have to own them in the same size that we do. when we sell things or add to them, don't feel like you have to, but just use it as kind of a learning tool and just ask yourself, why do you think the guys are doing adding this or subtracting? And that's why we're doing this every week, to try to communicate as much as we possibly can to all of you.
And you know what? We keep on saying that we're going to try and make these shorter, but you know, time gets away from us. So hope you enjoyed it, folks. We're going to see you next week. And also, I just want to say, I hope everyone has a great 4th of July holiday. Don't forget that tomorrow the market is just going to be a short day. And if you're so inclined, Webby's going to be on the podcast this week. We're going to try and dig a little bit deeper into downside reversals. So that's something that's going to be dropping later on this week. We're going to be taping tomorrow, using the advantage of that shortened day to get a little bit of extra discussion time in. But I hope everyone has a great holiday, great 4th, and we will see y'all next week. Take care.